Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. As of this week, it's 5 years since I started the Moneymakers Investment Trust podcast. Back then, we were in the middle of a dramatic market sell-off triggered by the COVID outbreak and the announcement of lockdowns. And by a strange coincidence, we're ending it with another potentially dramatic market downturn. This case prompted by President Trump's announcement earlier this week of his great tariff program, which is designed, in his view, to create more manufacturing jobs in the United States, cut the US's trade deficit, bring down the value of the dollar, and in time create space for more tax cuts. Well, those ambitions don't look so smart now, and it certainly hasn't gone down well in the markets, judging by the severe reaction over the 2 trading days since so-called Liberation Day this week, coming on top of what has already been a clear downward trend in the US market since the inauguration. The S&P 500 had its worst 2-day and monthly performance since those dark days of COVID, more than reversing the positive trend we saw in the latter part of last year, as investors look forward confidently, but unwisely as it now appears, to Mr. Trump's new administration. $5 trillion was knocked off the value of the US equity market in 2 days. That's some going. The knock-on effect on other countries has also been instantaneous and mostly painful, with the European and Asian markets falling sharply as a result. Europe down 8%, the UK 7%, and Asia nearly 5% in just 2 days. With China announcing retaliatory tariffs of its own, fears of a global trade war and subsequent recession have seen the price of oil and copper also tumble, while bond yields have softened, but not by the same degree as equity markets have tumbled. The scale of the tariffs that the US is unilaterally imposing on all its trading partners is unprecedented in modern times, and in terms of overall impact, takes us back to the dark days of the Smoot-Hawley tariffs in 1933, whose introduction is still widely regarded as one of the triggers for the Great Depression. So that's not a particularly encouraging precedent. Nor indeed is the way that the uncertainty that was created initially by the threat of those trade tariffs is set to continue even now that they've been announced, as there's no certainty about how long those tariffs are set to last, or indeed at what level they will settle. Yes, it may all be a negotiating tactic, but we don't know for sure yet how different countries are going to respond. Some, like China, are already retaliating. Others are saying they're going to do nothing for now and consider their options, which may in some cases include trying to strike a deal with the Trump administration to avert the worst impact, and that includes the UK. However, unless the new tariffs are walked back quickly and a trade war can be averted, the impact in the short term, as Jay Powell, the chairman of the Federal Reserve, commented on Thursday, will inevitably be higher inflation and slower growth. A noxious combination. And what we can say is that this particular way of approaching the issue that the administration has chosen means that uncertainty looks set to persist. And that in itself cannot be positive for companies making decisions about where to invest and how to grow their business. And that in itself cannot be positive for companies making decisions about where to invest and how to grow their business. So it doesn't make for a great short-term backcloth. Obviously, I think if you talk to the likes of Scott Bessent, the Treasury Secretary, a former hedge fund manager who knows his way around markets, I think they will try to argue that the longer-term benefits will outweigh any immediate short-term market impact. That market impact looks, from the market reaction, to be primarily negative for economic growth in the US and around the world, but also with a perhaps less marked impact on inflation. How much inflationary pressures are created by these tariffs will depend on, among other things, how quickly, or indeed whether they do at all, companies push through the tariff increases into higher prices, or whether the market will allow that. So some of them may just take a hit to their profit margins, which will also be negative for their stock market rating. So all in all, it's been a very dramatic week. And it is a strange coincidence that we are talking today about a market sell-off that certainly has the potential to match up to that which we saw at the very start of the podcast 5 years ago. So the impact on the investment trust has also been very significant, and that's, of course, the primary focus of the podcast, has been from the very beginning, though we also cover issues like the global economy and so on. So not a good week for the world economy, at least judging by the market's reaction, and not a great week for the investment trust sector either, even though the UK has, in relative terms, come out of this process rather less severely hurt than a number of other countries, particularly those in Asia. Fewer than a dozen investment trusts out of nearly 300 managed a positive return this week. One of them by a happier coincidence being BH Macro, the listed hedge fund investment trust, whose chairman featured in our last episode, which was released earlier this week. More than 30 trusts lost more than 10% of their value. More on all this next week, but for the moment, the interview you'll follow is with Alexander Fitzalan Howard, who is the manager of the JP Morgan European Growth and Income Trust. We recorded that just before the announcement from the president and added a very short postscript. But then we'll be coming back to this subject next week when we will be talking, among others, to Craig Baker, the manager of the Alliance Witten Trust, a global equity investment trust, which of course will also be affected by the changes that we are now witnessing and what many think may be the most dramatic change in the global international order for many, many years. So please stay 5 years, but we'll be carrying on for longer. So do feel free to stay listening to the podcast and sign up for every new episode that we produce. I'd like to thank you all for listening. Over the past 5 years, it has been a very eventful ride, and I've learned a lot, and I hope that you too have gained something from our weekly interviews and summaries of what has been going on in this most interesting sector in the UK equity market. So this week I could not think of a more timely guest to have on the podcast than Alexander Fitzalan Howard, who's been the manager of the JP Morgan European Growth and Income Trust for 20 years, no less. So a very seasoned campaigner. And I guess that experience is something that you're going to want to be able to draw on this particular week. We're recording this on the 1st of April. And we're just all waiting, I guess, for the latest news out of the United States, where Donald Trump is poised to announce his tariff regime, his tariff war, you could call it. And meanwhile, we've also had a series of seismic political shocks across Europe, including the news about Marine Le Pen being barred from standing for the presidency in France, and some very recent and potentially significant developments in Germany. So, Alexander, first of all, welcome to the podcast. These are very interesting times, are they not?
First of all, thank you very much for having me on your podcast. And yes, extraordinary times in Europe. I think as far as Trump is concerned and Liberation Day, it's sort of almost impossible to predict what he's going to do. And one almost wonders if he really knows what he's going to do, because over the last few months, he seems to have changed his mind day by day. So I'm not sure there is much merit really in trying to predict what he's going to do on Liberation Day.
Yes, indeed. And he's talked about either doing a universal tariff regime where everybody gets slapped with the same rate, or what he calls reciprocal tariffs, which is essentially negotiating tariff arrangements with other trade partners. It's obviously going to be significant, even if we don't know how and in what way it's going to be significant. When you're talking to some of the portfolio companies that you have, how have they been reacting to the arrival of the new Trump administration?
Well, I think they're pretty nervous about it, like governments across Europe and indeed across the world. I think for companies themselves, it's quite hard for them to kind of rearrange their affairs to deal with what might come out. Clearly, some companies that have production facilities in the US or have them in Mexico maybe could shift around a bit, will consider that. But until they really know the lay of the land, I think companies are going to be quite reserved about their plans.
How have you reacted as well? Have you made significant changes to the portfolio, or are you essentially waiting to see how this all falls out?
No significant changes because of the tariff outlook, I would say. There's some areas where we think it is clearly likely to affect more than others, such as auto manufacturers. But there we've been nervous about them for some time and are not involved. So it hasn't really changed our view on that as such.
Am I right to zero in on what's been happening in Germany recently? I mean, how do you interpret what's happened there? Obviously, what we've learned is that the Germans, whose post-war industrial model is really threatened by things that are going on, including the war in Ukraine and so on, and they seem to have torn up their debt limits for the government and going to have a reset, I suppose you could call it. How significant is that as far as you're concerned?
I think potentially that could be a really significant moment for Europe. As you indicated, they've kind of release the debt brake, so they will be able to borrow more money. Say that's not just for defence, but also for infrastructure spending. And the figures are big. The figures are really significant. And I think that will be a big change. Europe only seems to really react and take action when there is a crisis. And you're seeing that at the moment. I mean, clearly, politicians across Europe are very nervous indeed that Trump has kind of changed the playing field almost completely, and they need to react. And I think we're seeing from Germany that they're prepared to do that. Is very unusual for Germany. That's been so conservative historically that to back away from that debt break, I think is very significant. And I think there have been some significant changes elsewhere in Europe too on the defence side. I think Europe realises that it is going to have to take action on that front and take more of the lead rather than just relying on the United States. And to be fair, I think Trump had a point about that Europe was not paying its way. Having said all that, Germany's made the right first move, but they do need to follow through on it and actually take action. And that will take some time, and you can't just flick a switch, basically.
And of course, there are political uncertainties in Germany as well. We know who the new chancellor is going to be, but it's still a fluid political situation there, as is indeed the case in France, where we obviously got this current, well, some people regard as potentially a crisis there in political terms. That must be unsettling as well towards business sentiment and indeed investor sentiment.
Yes, sort of up to a point. I don't want to be flippant about it, but the sort of political crises across Europe are quite normal. And one of the key things really in the way that we try and invest is to try and ignore a lot of that political and macro noise and really focus on what the companies are doing. So I'm not sure what the outcome will be of the current situation with Le Pen. I think it's difficult, as I understand it, that historically her party have criticised everybody else a lot for corruption, and then it seems to have been turned around on its head, and then suddenly she's in the firing line. But how it plays out, I don't really know. And how it will play out kind of at the popular level, I'm not sure either. There have been a lot of statements yesterday or over the weekend anyway about, democracy is dead or democracy has been executed or whatever. But I think let's just sort of see what actually happens. The corporate world tends to move on and has navigated its way through previous crises pretty well.
So I guess on a more positive note, though, the ECB has made some interest rate cuts, and the markets seem to be expecting there'll be at least one more or maybe several more to come because of the position in which Europe is relative to perhaps some other regions and countries. So that will be a positive, I imagine you'd like to think.
Yes, I mean, the market is expecting a couple more cuts this year. The ECB has been very clear it'll be data dependent, so they're going to wait and see what happens. I think one thing we do need to keep an eye on, though, is what's happening at the long end of the bond market. And it would be a worry if yields at the long end ticked up too far. If, for example, inflation started to come back, or if the market started to get nervous about much more issuance, for example, from Germany to finance this infrastructure spending and so on. So we're keeping an eye on that. But I think the ECB, the trend is down now, and that is basically positive.
As we say, you've been doing this for 20 years, and Europe has had all sorts of crises over that period. We had the GFC, we had the whole will the euro collapse saga back in the early 2010s. And of course, more recently, we had the war in Ukraine and COVID to deal with. But you've managed to steer a very consistent path through all that in terms of the trust and its performance. Have you been surprised by the strength of European stock markets in relative terms over the last few months since Trump arrived?
Not entirely, because the time that Europe is sort of picking up a bit, we've discussed the infrastructure and defence spending possibly and ECB cuts, but the consumer in Europe is quite robust. Real incomes have been going up and consumer confidence is quite strong. Real wage growth is a big driver. Unemployment is pretty low. So the consumer's been quite strong. But on the other side of the Atlantic, President Trump, obviously there's this noise around tariffs, but there's also been this big cost cutting, Doge and all of that. So government employment is probably coming down, and there are probably going to be cuts to social security and so on, which is all not a positive sign really for US in the short term. And the big difference, of course, is that European markets are valued much more cheaply than the US. And a lot of European investors have been saying this for many years. The differentials tended to get even wider. But finally, maybe there's a catalyst to change that. And so as you point out, in the first quarter, US market has not performed very well, but Europe has been quite strong. And I think I'm right in saying that European markets have now outperformed the US market over several years now.
Yeah, so this could be the start of a trend.
Well, as a European investor, we're hoping so. Yes.
It could be the start of a trend if we get some rotation out of the US into other regions, yeah. I also have to say, looking at the performance charts and so on, your trust has done particularly well since the Trump election in particular. You outperformed your peer group and your shares, I think, are pretty close to an all-time high. So that's impressive. How do you explain that in terms of just in that narrow period, the relative performance of your trust versus your peer group, on whom I'm sure you keep a wary eye?
Only from a distance. I mean, in the short term, I'm not sure exactly what they've been up to, but for us, the whole way that we invest and what we're trying to do is to build basically a core portfolio. We're aiming for consistent, incremental, and ideally repeatable performance. So we're not trying to shoot the lights out, but equally, when things don't go well, it's not going to fall completely out of bed. So we're running a pretty balanced and diversified portfolio. There are quite a lot of risk controls in there. And it's all about steady incremental performance, whatever the market conditions are. So unlike some of our competitors, we're not really growth orientated. We're going to be a balance of growth and value. And I think it's fair to say over the last few years, value has come back into fashion a bit after years in the wilderness. And that has done us very well.
And also, of course, one of the factors behind your relative performance over the shorter period is that the discount on your shares has come in a little bit, which is obviously good to see. Are you actually seeing, in terms of demand from investors, institutions in particular, or wealth managers and so on, some extra demand that you haven't seen for a while?
Yes, I think that's fair. I think given the good performance over the last few years, it's come up on a lot of radar screens, people looking for European exposure. And it's fair to say that more and more of the wealth managers and investment platforms have started to pick up on it. And as a whole, we're seeing more of the shares owned in effect by retail investors. And that, I think, has helped the discount close up a bit.
One of the distinctive features of your trust, as indeed many other JP Morgan trusts, is the fact that you run an enhanced income policy. You have done for, I think, about 3 years now. Have you found that that is going down well? It's interesting in a way. I always find it fascinating that enhanced income seems to work, even though in theory it probably shouldn't work because it's all transparent and capital or income. Have you actually found that coming up as a reason why people might be looking at your shares rather than some of the others?
Yes, I think retail investors in particular like the idea that the income is very predictable. So the board stated that they will pay a dividend of 4% of the NAV at the end of each financial year. And they'll pay it quarterly over the subsequent year. So there's a lot of visibility there for investors. They like it. It's one of the advantages of an investment trust rather than an open-ended fund, that they can pay the dividend out of reserves if necessary. And our portfolio at the moment yields about 3%. So the missing piece is paid out of reserves. What's really important to state, though, is that it does not affect the way that we invest the portfolio. We're investing on a total return basis, and we're not having to chase income in the market. So it's not distorting what we're trying to do from the purely investment point of view.
So as a fund manager, that actually makes your life a little bit easier in a way.
Oh, much easier. Yes. No, it means that the dividend decision is one taken by the board. They've made that sort of strategic change. We can just carry on investing as we see fit on a total return basis.
So the date for settling the dividend for the coming year was actually, well, the close of play yesterday, I imagine, 31st of March. And the NAV this morning is somewhere around 119p, something like that.
That's right. Yes. Just over, I think.
Yeah, just over. Okay. So, and the share price is still at a small discount. So people can work out what the actual kind of yield will be from here for the next 12 months. They know that now.
Yes, absolutely.
Okay. So looking at the trust overall, I mean, you're not the largest trust in the sector, I think it's fair to say. You're about 470 million when I look at the numbers, but you have this strong performance record. What was it when you started, out of interest? Can you remember what the market cap was when you started back 20 years ago?
I can't remember that, I'm afraid. Some way below it, I think.
Yeah. And I think you've sort of compounded around 10% per annum with different periods in between, which is very respectable. Do you feel any pressure from the things that are going on in the investment trust sector? So we've had Saba Capital chasing a number of trusts, not yours, I think, and 470 million. Is that going to be big enough for all the wealth managers in the current climate?
I think if you look at the top end of the wealth management league, they would prefer something bigger just for liquidity reasons. And I think the board is very aware of that. I think it's sort of mid-sized in a sense, and that's what we're sort of dealing with at the moment. If there was an opportunity to get bigger, I'm sure we would be keen to take advantage of it. Obviously, we're trading at a discount now. So in terms of issuing new shares on a sort of regular basis, that's difficult. But the discount has been closing up, and obviously the sort of dream of many investment trust managers is to trade at a premium and thereby be able to issue some more shares. I think if one was much below the size that we are, I mean, say half what we are, then you're really quite vulnerable and should be concerned.
So this is the new reality of the investment trust world at the
Yes.
moment.
I mean, I think Saba has chucked quite a rock into the pool. It's interesting how he has been seen off for the moment by the 7 trusts that he approached.
Yeah. I guess one of your competitors, the European Opportunities Trust, has certainly been in their sights and has had to try and deal with that. But tell me about your discount policy, or the board's discount policy. You have been buying back shares, I think.
Yes.
And you have a target, I think a single-digit target. Is that right?
Yes. I mean, to be clear, this is absolutely the board's call rather than us as managers. But yes, they've been very open, I think, that they do not want to see the trust trade at more than a 10% discount in normal market conditions for any length of time. And I think they've shown that they're prepared to back that by stepping into the market and buying a bit of stock when necessary.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. In terms of the structure of the trust, the closed end obviously has its pros and cons. In terms of being the manager of a trust, you also manage, I'm sure, some open-ended trusts, I know you do. Are the so-called advantages that we often hear about for investment trusts, do you actually find that in practice helpful, the fact that you don't have to worry about flows in and out of the fund and so on, you can use gearing and so on? Do you actually find those advantages a significant advantage or just something that is at the margin?
No, I think they're very important. You mentioned gearing, and we have taken a decision in conjunction with the board that we will always have some element of gearing deployed. And the feeling was that over time, markets tend to go up. So gearing makes sense. Obviously, it can be quite volatile and markets don't go up all the time. And therefore, that level of gearing probably wants to be quite modest. We were also very clear that we don't think that we as managers can time the market. So much though we would love to, we didn't think we could consistently add value by putting gearing on and off. So what we've agreed with the board is that we will have a gearing range in practice of between 5 and 8%. And the range is quite modest because we don't want the gearing decision to swamp all the other actions that we're doing. So we really think that where we as managers can add value is stock selection. And we don't want the sort of volatility from gearing to swamp that out. So gearing is one thing. The dividend we've already discussed, but clearly you couldn't have that sort of dividend policy in an open-ended trust. I think the third quite important thing relates to the flow question you raised, is that it means we can invest a little bit more maybe down the lower end of the market cap scale. So still quoted stocks, but much less liquid ones. And that gives us a bit more flexibility. I think those are probably the 3 key advantages. And yeah, I think they're definitely worth having.
I mean, you also use another JP Morgan investment trust for a little bit of exposure to those smaller companies. How much of the portfolio, though, is smaller companies that you have actually chosen? What percentage are we talking about here?
At the moment, we're talking about 10%, give or take. And that varies quite a lot. I mean, I think if you look back over the last 10 years, it's been as high as about 20% or as low as about 5%. And we don't take a sort of policy decision that we want to have more small cap or less small cap exposure. It just depends, and this is how the whole portfolio is run. It's all bottom up, and what sort of interesting opportunities are presenting themselves or we're finding, and we think we can take advantage of. But at the moment, about 10%.
Right. So at the moment, you're roughly in the middle of that range, as it
Yes,
were.
yeah.
Somewhere around there, yeah. So you've said already you don't have a particular style. You can have value, you can have growth, and so on. But you are a core holding, so you're controlling what technical terms we call the beta. You're pretty close to 1 in terms of market exposure. So it's all down to stock picking. What sort of turnover do you have in the trust? Has there been any significant deviation in the amount of turnover that you've been doing recently?
No, the last few years, we've been doing roughly 25% in and out on an annual basis. That sort of stayed quite consistently over the last few years. Yeah. So not great turnover. We're not churning around trading in the markets like that.
Okay, so let's just look at the last 12 months or so, and if it has been around 25%, what sort of things have you been doing? I mean, obviously the place to be, well, financials are done pretty well and autos are done badly, obviously. But what other kind of themes could one pick out of that activity of yours?
I think if you looked at our portfolio at the end of the calendar year, we were pretty exposed to financials, as you mentioned, and probably on balance quite cyclical. So exposure to, for example, retailers and media stocks, sort of quite high on the sector breakdown, and underweight quite a lot of the more defensive things like household and personal products and food and beverage, sort of staples companies. If you look at what's been happening this year, we're still, in fact, we're probably more overweight financials, but we've backed away a little bit from the cyclical exposure. And some of the staples companies, for example, we've focused on a little bit more. So that's probably the broad brush change, I would say. But financials remains a key area at the moment. After years in the wilderness, European banks in particular, but also insurance companies have really started to deliver. I think after the financial crisis, they restructured their balance sheets, recapitalized their balance sheets really, and are now earning significant returns on investor capital, returns on tangible equity, I suppose, for a bank. And because their balance sheets are in good shape, they're able to return a lot of that excess earnings to shareholders through dividends and share buybacks. And yet the stocks were incredibly cheap. And despite the recent performance, because the earnings have grown so fast, at least in PE terms, they still look very attractive.
So I guess that's partly the fact that investors have long memories and there may be an element of trust there that they can't quite believe what they're seeing.
I think that's right. I mean, when I first started at Fleming's in the mid-80s, my first role was as a financials analyst. And then the banks in the UK were trading on low single-digit Ps, and they had a pretty terrible time. So as you say, some of these things are sort of burnt into investors' psyche, really. But I think that's changed, and there's been a big opportunity there.
And so if we look at the kind of valuation of your portfolio, how does that compare to the European market as a whole? And you've talked obviously about the fact that there's a discount in valuation terms to the US, though I guess a small premium to the UK, which is always lagging. What would the number look like at the moment in terms of sort of PE and price to book and things like that?
In terms of PE, the portfolio as a whole now is currently trading on about 13.5 times against the market of 14 and a bit. I'm not sure what the exact figure would be. Maybe just to take a step back and to say what we're trying to do. We mentioned value and growth. When we're building our portfolio, we want the portfolio as a whole to be cheaper than the market, to have better quality than the market, and a sort of proxy for that would be return on invested capital, and to have better momentum, and particularly operational momentum. And our sort of proxy for that is earnings revisions. So if we can find companies that are generating good return on invested capital, are cheaper than the market, and then start to get earnings upgrades, then that's the sort of thing that we'll be all over. Now, not every company has that, but the portfolio as a whole will always tick those three boxes.
And if you compare it to the performance of your benchmark or passive funds, what kind of margin of superior performance do you think that an active manager has to develop in order to be competitive? It's been a very tough ask over many, many years for most fund managers. How would your record compare on that, and how do you think about that?
Given that we've tried to position this trust as a core portfolio, if we can generate approaching 2% alpha per year, then that has shown to be enough within that space. Now, some people obviously want to push it further, and when things are going their way, you mentioned one of the names already, when things are going their way, they will do better than us. But there's, shall we say, less consistency there, and then when things are not so good for them, it tends to be much more painful. Our aim is more the sort of steady eddy, incremental performance, and over time, I think that has played out pretty well.
Finally, looking back over your 20 years as being involved in managing the investment trust, what have been the kind of standout performers for you over that time in terms of portfolio components?
I think the most alarming time was the great financial crisis. And I can remember being in a board meeting with the Investment Trust Board, I think in Munich, but I can't remember now because they used to do one meeting a year in Europe. And there was genuine concern as to what banks were going to fail, and there were big problems in the derivatives market, and were things going to be settled. I think that was probably the most alarming financial moment. And then I think the other defining moment in a way was the war in Ukraine, and the way that I think that has changed a lot of things.
It certainly has. I wonder what you thought when you were given the mandate of working on European stocks, because back in the 90s, the market was not as well developed as it is now. In terms of companies being open for investors to go and talk to them and things like that, there wasn't a huge amount of research and so on. Would you say it is now a fully mature market, the European market, if you see where I'm driving at with that question?
As a sort of prelude, I should say, during the 90s, I did the US market, and then for various reasons switched across at the end of 99. So given that was a sort of pretty much at the peak of the tech bubble, that was quite an interesting moment to switch across to Europe. And I found it absolutely fascinating. I mean, I think you're right. It was a sort of less deep capital market than the US, and it still is. But I think there's a misunderstanding of Europe when people say, oh, the US leads in everything. I don't think that's true. I think there are areas where Europe has some genuinely world-leading companies that can compete with the US on equal, if not better terms. And there are bits of the semiconductor space, for example, particularly in the capex end of semiconductors, ASML, ASMI, for example, or luxury goods. The European companies there are world leading. So I think there are lots of opportunities in Europe, still are, and you can get access to these companies in Europe at much better valuations than in the US. And that, I think, has been a good story, and hopefully is becoming a more powerful story as the US falters a little bit.
I have heard some people argue that this actually could be quite a good moment for Europe in the sense, as you said at the beginning, that this is a kind of wake-up call on the defence side, but also perhaps a wake-up call about some of the entrenched positions within the EU that we've seen, particularly in Germany. And I know that President Macron said about a year ago, didn't he? He said, it's quite strange that we're exporting all this stuff to America. We do actually have some economic power as well as the States does, and we therefore perhaps haven't actually fully appreciated that, and we need to kind of flex our muscles and use our strengths to actually move European economies forward.
Yes, absolutely. I mean, I think he's right. But in this sort of tariff moment, exporting lots of stuff to the US suddenly makes it quite vulnerable in a funny way. So this could be a difficult moment.
I mean, there's short-term and long-term, I guess is what I'm saying.
Yes, exactly. Yes.
Short-term pain and possibly long-term gain, because these are complex matters, tariffs. Well, on that note, thank you very much for sharing your thoughts with us. I hope that things develop well over the next year or two, but in the short term, it could be quite a bumpy ride. I guess that's what you're suggesting.
It's always a bit of a bumpy ride, but I think there are lots of opportunities out there. So we're confident that we can continue to find good investments within that.
So that was Alexander Fitzalan Howard, the long-serving manager of the JP Morgan European Growth and Income Trust, talking to me earlier this week.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.